Hello learners, I hope you are well. Welcome to our today's learning session. Someone said we never stop learning because the universe never stops teaching. Today we are going to introduce a new topic, and that is capital budgeting decisions under certainty. The topic is capital investment decisions, capital investment decisions under certainty. Capital investment decisions under certainty. In our introductory lessons, if you remember well, we talked about the functions performed by a finance manager in a business organization. And one of the functions was the capital budgeting decisions. It is the function of the finance manager to advise the management as far as capital investment decisions is concerned. He's supposed to advise which projects to invest, which projects to reject. He's supposed to advise other than making financing decisions which involve the sourcing of finances. The finance manager should also advise the management on the investment projects to undertake. So before we go into the topic, I would want to give a brief adumbration of this topic. Now, in this topic, we'll be looking at the nature of capital investment decisions. We will study the categories of capital projects. We also discuss the capital budgeting techniques under certainty. We are also expected to learn what we call capital rationing. So in this lesson, we start with the introduction. And the introduction, we would want to define what we mean by capital investment. Capital investment. Capital investment. What is capital investment? These are funds invested in a firm or a company for the purpose of furthering its business objectives. Capital investment may also refer to a firm's acquisition of capital assets or fixed assets such as a manufacturing plant, machinery, and so on, that is expected to be productive over many years. So this is investment, in other words, in long-term assets. We have given an example of plant and machinery. When a company invests in long-term assets like plants and machinery, we say that is capital investment. So that is what we mean. And the finance manager is expected to advise the company when such decisions are to be made. Expected to advise. That is his or her jurisdiction. So capital investment again is simply the investment in long-term assets. So one duty of a finance manager, as I've said, is to choose investments with satisfactory cash flows and rate of return. Okay, it is the duty of a finance manager to choose investments with satisfactory cash flows and rates of return. Therefore, a finance manager must be able to decide whether an investment is worth undertaking and be able to choose intelligently between two or more alternatives. So that is the work of a finance manager, and that is what we are training you to do, to be doing. You are taking these lessons so that when you step out into a profession, when you start practicing as an accountant, as a finance manager, you will have the relevant skills, you will have the relevant knowledge that will enable you to advise on making, or to advise, or you will have the relevant skills that will enable you to make intelligent decisions. We are saying you should be able to choose intelligently between two or more alternatives. Between two or more alternatives. Because again, I remind you, financial resources are generally limited. Organizations do not have unlimited financial resources. But on the other hand, an organization may have many opportunities that it may undertake. There are many competing needs, many projects that can be undertaken. But all these projects cannot be undertaken. Some projects should be undertaken, other projects should be rejected. So it is the work of the finance manager to advise, given the inability or given the unavailability of financial resources. So resources are scarce. So it's very important to invest intelligently. To be able to choose intelligently, the finance manager must follow a sound procedure to, number one, evaluate, number two, compare, and number three, select projects which are needed. And this procedure is called capital investment decisions or capital budgeting. Therefore, capital budgeting is an essential managerial tool, as the success and growth of any business enterprise depends upon efficient utilization of resources. Efficient utilization of resources. So the way or the manner in which you invest your financial resources will determine as to whether the company will succeed or it will fail. Because again, you need to remember that every company has an objective, and we looked at two of the objectives, that is the profit maximization objective and shareholders' wealth maximization. So if the objective is to maximize profit, then resources must be well invested. The financial resources must be invested well. The money, financial resources, and other resources, human resources, must be coordinated, must be integrated in such a manner as to maximize the objective of the firm. The objective of the firm, which may be profit maximization or shareholders' wealth maximization. So that's why capital budgeting is very important. It's very important. It will in many aspects. So capital budgeting relates to the capital expenditure decisions. Again, capital budgeting or capital expenditure decisions may be defined as the firm's decision to invest its current funds most effectively in the long-term activities in anticipation of expected flow of future benefits over a series of years. Over a series of years. So in capital budgeting, the current funds are invested with a view of or expecting to reap or expecting to have future cash inflows, future cash series of cash flows in future. For example, when you invest in long-term assets like plants and machinery, you do not expect returns or you do not expect to have cash flows immediately. These are long-term assets. These assets are expected to generate cash flows. In fact, it's a series of cash flows in future. Series of cash flows in future should be expected to be generated from investment in long-term assets. So capital budgeting involves the entire process of planning expenditure whose returns are expected to extend beyond 1 year. It means that the capital budgeting involves the planning and control of capital expenditure. It involves the planning and control of capital expenditure. So capital budgeting again enables the management to assess the demands for funds and selecting projects to use those funds more effectively. We are talking about capital expenditure. It involves the planning. It involves the control of capital expenditure. So that is the introduction. We've just looked at the introduction of capital investment decisions under certainty. We now want to study nature of capital investment decisions. Now, an effective or an efficient allocation of capital is the most important finance function in the modern times. It involves decisions to commit the firm's funds to the long-term assets. Capital budgeting or investment decisions are of considerable importance to the firm since they tend to determine its value by influencing its growth, profitability, and risk. It will determine the growth of the firm, profitability, and the riskness of the firm. So that is very important. Then the investment decisions of a firm are generally known as capital budgeting or capital expenditure decisions. And the following are the features of investment decisions. Number one, the exchange of current assets for future benefits. Number one, exchange of current. Number one, exchange of current for future benefits. Exchange of current for future benefits. You forego comfort, current comfort, expecting to have benefits in future. It is the same concept even with you who is learning. When you are learning, you are investing your financial resources in buying study materials, in buying video lectures, in foregoing certain comfort so that you can learn. You are sacrificing current comforts so that you can have future benefits. I don't know why you are studying accounting or finance but one reason could be so that you can have knowledge and skills to enable you be more efficient, more effective in your financial duties. So you are sacrificing your money now with the expectation that you will reap in future. That is the nature of capital expenditure. You have forego the current and expecting to have benefits in future. So that is very important, the exchange of current funds for future benefits. Number two, the funds are invested in long-term assets. The funds are invested in long-term assets. Long-term assets. I know by now you know the different categories of assets. You have current assets which involve assets like inventories, okay, or prepaid expenses, when you pay expenses, or assets like debtors. These are short-term assets because they are meant to last in the business for a period of less than a year. But again, we also have non-current assets. Non-current assets. These are long-term assets. Long-term assets. Investment in long-term assets. When you buy a long-term asset like machinery, when you buy a long-term asset, when you invest in machinery or plant or motor vehicles, these are non-current assets. These are long-term assets, and these assets are meant to help in generating more revenue. If you buy, say, a delivery van, okay, making deliveries, that van is meant to serve you for a period of more than a year. So that is a long-term asset. So that is another aspect of capital expenditure. Then future benefits will occur to the firm over a series of years. Future benefits will occur to the firm over a series of years. So when we invest in a long-term assets, we will have a series of cash flows or benefits in future. Benefits in future. You will not just reap once, you will reap continuously. For example, when you qualify to be a finance manager, you will not earn once, it will not be lump sum. It will be a continuously, maybe throughout your life. Even after retiring, you will be earning still benefits, the benefits, pension. You will have pension on the basis of the investment that you are making now. So you'll have a series of inflows. If it is investment in education, you have salaries month in, month out, year in, year out. You're just reaping because you made a long-term decision. The same thing here with the companies. The company is expected to have series of cash flows over many years. So that is long-term investment in assets. That's what it does. Okay, so these are some of the features of investment decisions. Okay, capital investment decisions. So why is it important? What is the importance of capital investment decisions? Capital investment decisions. I've said, and I'm repeating, capital budgeting is a step-by-step process that businesses use to determine the merits of an investment project. The decision of whether to accept or deny an investment project as part of company's growth initiative involves determining the investment rate of return that such a project will generate. However, what rate of return is deemed acceptable or unacceptable is influenced by other factors that are specific to the company as well as the project. So capital budgeting is important because it creates accountability and measurability. Okay? It creates accountability and measurability. Any business that seeks to invest its resources in a project without understanding the risks and returns involved would be held as irresponsible by its owners or shareholders. So if shareholders have entrusted you with their resources, and in the process of investing these resources, you don't take into consideration the riskiness and the return on investment, then you are a very irresponsible manager. Very irresponsible manager indeed. So, and we are also saying that a social, for example, and a charitable project is often not approved based on rate of return, but more on the desire of a business to foster goodwill and contribute back to its community. So, furthermore, it can be argued that if a business has no way of measuring the effectiveness of its investment decisions, chances are that the business will have little chance of surviving in the competitive marketplace. If a business has no way of measuring its effectiveness of its investment decisions, then chances are that the business will have little chance of surviving in a competitive marketplace. Remember, capital budgeting gives us an opportunity to assess, gives us an opportunity to evaluate the effectiveness of projects. So businesses exist to earn profits. This we discussed in our last lessons. One of the main purposes of engaging in business is profit maximization. So the capital budgeting process is a measurable way for businesses to determine the long-term economic and financial profitability of any investment project. So that is important. Then another point is that capital budgeting is also vital to a business because it creates a structured step-by-step process that enables the company to, number one, develop and formulate long-term strategic goals. That is a very important point. I'm repeating it. I'm saying that capital budgeting is vital to a business because, number one, it helps the company to develop and formulate long-term strategic goals. Long-term. You underline the word long-term. Long-term strategic goals. Because the ability to set long-term goals is essential to the growth and prosperity of any business. The ability to appraise or value investment projects via capital budgeting creates a framework for businesses to plan out future long-term direction. That is point number one. Point number two, it involves, let's talk about seeking out new investment projects. Seeking out new investment projects. Knowing how to evaluate investment projects gives a business the model to seek and evaluate new projects, which is an important function for all businesses as they seek to compete and profit in their industry. Because remember, in capital budgeting, we are looking at different projects, many projects, evaluating project number one, evaluating project number two, getting information about many projects. That is a process that will help the company to seek out new investment projects. It is a process. In the process of evaluating many projects, the company is in a position to determine which project will generate more return, or which project is less risky. So that is an important point. Then point number 3, estimate and forecast future cash flows. Future cash flows are what create value for business over time. Future cash flows create value for the business over a period of time. So capital budgeting enables executives to take a potential project and estimate its future cash flows, which then helps determine if such a project should be undertaken. So before a project is undertaken, in capital budgeting, we do what we call estimation of future cash flows. You estimate. If we are, for example, to invest in machinery, a machine, then we should be able to estimate over the next, say, 5 years, after year 1, what is the expected cash flow from this investment in machinery. If it is a van, I gave an example here of a delivery van. What is the expected cash flows, the expected benefits to be derived from investment in this delivery van over a period of years? Say year 1, after year 1, what is the expected cash flow? Year 2, what is the expected cash flow? Year 3, what is the expected cash flow? So capital budgeting helps in estimating or forecasting future cash flows. Number 4, facilitates the transfer of information from the time that a project starts off as an idea to the time it is accepted or rejected. Numerous decisions have to be made at various levels of authority. The capital budgeting process facilitates the transfer of information to the appropriate decision makers within a company. Remember, in a company setup, decisions are not made by one person, and one person cannot get all the information. The final person to make the decision will rely on information that is relayed to him or her from other departments. So in capital budgeting, there is always information, transfer of information. For instance, machinery. The machinery, the finance manager may require technical information on which to base his decisions as far as the operations of the plant is concerned. So the plant manager is supposed to relay information on the capacity of the plant, what is the capacity of the plant, the production capacity of the plant, because returns or cash flows are dependent on production capacity. So information is relayed from one department to another, transfer of information, which gives the final person making the decision enough decisions or enough information upon which to base decisions. So capital budgeting, which is a process, it helps in relaying of information from one department to another. It may be information from the market, that may be communicated to the finance manager by the marketing manager. So there is that transfer of information. Another point we can mention here is monitoring and control of expenditure. By definition, a budget carefully identifies the necessary expenditures and research and development required for an investment project. Since a good project can turn bad if expenditures aren't carefully controlled and monitored, this step is a crucial benefit of the capital budgeting process. So we have monitoring and control of expenditure. Then lastly is the creation of decisions. When capital budgeting process is in place, a company is able to create a set of decision rules that categorize which projects are accepted and which projects are unacceptable. The result is more efficiently run business that is better equipped to quickly ascertain whether or not to proceed further with a project or shut it down early enough in the process, thereby saving a company both money and time. And we'll be looking at these in detail. We'll be looking at the techniques in capital budgeting. Every technique has a rule, criteria, or rules which guide in whether to accept a project or reject a project. It's called decision criteria rules. Decision criteria rules. So with that information, we come to a close to our lesson today. Remember, we just introduced capital budgeting, which is also referred to as capital investment decisions and uncertainty. We have defined what is capital investment. We have looked at the reasons why capital budgeting is important in an organization. We also say that capital budgeting is simply the investment in long-term assets. We have also mentioned the features of capital budgeting decisions or investment in long-term assets. We say that it involves the exchange of current funds for future benefits. Current funds for future benefits, number one. Number two, it involves the investment in long-term assets. Then number three, we've talked about having series of benefits in future or series of cash flows in future. After investing in long-term projects, you are expected to have a series of benefits in future. So with that, we come to a close to our first lesson in capital budgeting. We'll be having series of lessons under this topic. Thank you. I advise you, go read ahead. When we meet next time, we compare notes. God bless you.